You've probably heard the saying, sell in May and go away. But is there any truth to it? In this video, we'll break down what seasonality is, how it affects both traditional markets and crypto, and whether you should actually care. In finance, seasonality just means that certain patterns tend to repeat at specific times of the year. They're usually driven by predictable investor behavior during recurring events like tax deadlines, bonuses, or holidays. For example, stocks often underperform from May through September, hence the phrase, sell in May and go away. Then comes summer break, and markets tend to see a lull from June to August. Or take the Santa Claus rally, where stocks often rise in late December. This might be because investors sell off underperforming assets early in December to harvest tax losses, then buy back into stronger performers as the year closes. But what about crypto? Since crypto is closely tied to the stock market, it's no surprise that we see many similar seasonal patterns, though not without differences. January is often a good month for Bitcoin, with historically positive returns, possibly driven by fresh capital entering the market at the start of the year. February is usually solid too, making Q1 generally favorable for crypto. March, however, tends to be more volatile. Bitcoin had negative returns in 9 out of the last 15 Marches, though its average return was still positive. This might have something to do with tax season in the US and UK, when investors might sell crypto to cover bills or capital gains taxes. April, however, often brings recovery. It's historically Bitcoin's second best performing month from 2011 to 2024, only behind November. Why? Perhaps because once taxes are out of the way, investors buy back in or rebalance their portfolios for Q2. Then comes the May to September stretch. Sell in May and go away is an old saying that points to a tendency for markets to underperform during this time of year. Though the reality's a bit more nuanced, July, for instance, often does pretty well for stocks. Crypto also tends to slow down during this time. From 2011 to 2024, data shows that while May can still be decent, things start to cool off more noticeably in the summer. August and particularly September are Bitcoin's weakest months on average, posting slightly negative returns. With traders on holiday and market activity dipping, prices can move sideways or even down for a bit. This mirrors the September effect in US stocks, where September has been on average the worst performing month for equities. Many believe it's due to investors returning from summer vacation to realize gains or harvest losses before the year ends. Cue the Green Day reference. Wake me up when September ends. Going towards the end of the year, this is when Bitcoin typically shines. October, or Uptober as some like to call it, and November have produced some of Bitcoin's strongest average returns. This could be because of end-of-year portfolio rebalancing or even holiday bonuses hitting wallets. Interestingly, these months also coincided with Bitcoin's major cycle tops back in 2013, 2017, and 2021. What about the Santa Claus rally? Does it affect Bitcoin? In stocks, the Santa rally refers to the tendency for markets to rise during the last week of December into the new year. For Bitcoin, though, it's more of a mixed bag. So it seems Santa has shown up more reliably for stocks than for crypto. The other overarching theory for seasonality is simply market psychology. If enough investors and traders believe certain months behave a certain way, the market often follows, making it a self-fulfilling prophecy. September is bad for prices, Uptober means up only. You get the idea. But at the end of the day, seasonality is just one lens for looking at the markets. Things like fundamentals, macroeconomic trends, and regulations likely matter more. If you'd like to get a refresher on your fundamentals, check out our video on Bitcoin right here.